I'm 30, what should I invest in? Or I'm 60, what should I invest in? To understand investing, you first need to understand the relationship between risk and return. The riskier something is, the higher its potential return is, and the less risky an investment is, the lower its potential return. So in general, stocks are riskier investments, but they have a much greater chance of offering a high reward, whereas bonds are lower risk but offer a lower return. So when you're young, when you're 30-ish, you want to be invested in high-risk investments with the highest potential for growth. So imagine if you're, anywhere around the age of 30, think about investing in a 100% stock portfolio. Because you have more time for the market to recover, you can tolerate the larger fluctuations in value in exchange for the potential upside. So the way that the market works, if you're invested in 100% stocks, is it's gonna go up and down way more often than if you were invested in bonds. And when you're young, you can tolerate that because it's gonna go up and down, but over the long term, it has historically always gone up more than the bond market has. So if you're willing to tolerate those ups and downs, you want to be invested more in stocks, which some people call an aggressive growth portfolio. Then as you get closer to retirement, you'll want to change your mix from mostly stocks to a mix of stocks and bonds so that your portfolio is less volatile. The way this works is bonds are much more steady in their returns. They offer lower returns, but steadier returns. So if you have a mix of stocks and bonds, it helps your portfolio kind of just go up and down a little bit less than it would if it were all stocks. So you can either make that change yourself of moving from stocks to more of a mix in stocks and bonds as you get closer to retirement, or you can invest in a target date fund that will do that for you. So the way that these work is as you get closer to retirement, it invests in a more equal stock to bond ratio, lowering your risk. To find the target date fund that's right for you, you just take the year that you plan to retire and do a Google search for, say it's gonna be 2050, you'd search target date fund 2050, and you'll find examples of funds that you can invest in that will do that for you. The best part about that is that, even if you're starting at 30, that portfolio is going to be made up of more stocks. So it is accounting for this risk to reward ratio that we talked about. All right, if you want to learn more about how to invest on your own, be sure to check out our free class, Think Like an Investor. We teach you the tried and true principles of investing so you can start building wealth today. All right, thanks for watching, and don't forget to subscribe and give it a thumbs up if you learned something in this video.